Hello viewers. Today in this video we will continue the topic about initial public offering. In the part 1, we had covered overview about IPO, types of IPOs, and its pros and cons. Next, we shall cover how are shares allocated in an IPO. There are different investor categories when it comes to IPOs. This includes qualified institutional buyers, non-institutional investors, retail individual investors. As an individual investor, they are allowed to invest in small lots worth 10,000 to 15,000 rupee. He can apply for a maximum of 2 lakh rupees in an IPO. The total demand for shares in the retail category is judged by the number of applications received. If the demand is less than or equal to the number of shares in the retail category, he will be offered a full allotment of shares. When the demand is greater than the allocation, it is known as oversubscription. To have informed knowledge about IPO, it is necessary that one comes to know about some basic terms used in the process. First, we have issuer. An issuer can be the company or the firm that wants to issue shares in the secondary market to finance its operations. Then, we have underwriter. An underwriter can be a banker, financial institution, or a broker. The underwriters also commit that they will subscribe to the balance shares if the stocks offered at IPO are not picked by the investors. After that, we have undersubscription. Undersubscription takes place when the number of securities applied for is less than the number of shares made available to the public. Last, but not the least, we have price band. A price band can be defined as a value-setting method where a seller offers an upper and lower cost limit, the range within which the interested buyers can place their bids. Next, we will talk about IPO process. The IPO process essentially consists of 2 parts. The first is the pre-marketing phase of the offering, while the second is the initial public offering itself. When a company is interested in an IPO, it will advertise to underwriters by soliciting private bids, or it can also make a public statement to generate interest. The underwriters lead the IPO process and are chosen by the company. A company may choose one or several underwriters to manage different parts of the IPO process collaboratively. The underwriters are involved in every aspect of the IPO due diligence, document preparation, filing, marketing, and issuance. Next, we will discuss in detail the steps to be followed while launching IPO. First step is proposal. Underwriters present proposals and valuations discussing their services, the best type of security to issue, offering price, amount of shares, an estimated time frame for the market offering. Next is underwriter. The company chooses its underwriters and formally agrees to underwrite terms through an underwriting agreement. Next is team. IPO teams are formed comprising underwriters, lawyers, certified public accountants, and Securities and Exchange Commission experts. After that is documentation. Information regarding the company is compiled for required IPO documentation. The S1 registration statement is the primary IPO filing document. It has 2 parts: the prospectus and the privately held filing information. Point 1. The S1 includes preliminary information about the expected date of the filing. Point 2. It will be revised often throughout the pre-IPO process. The included prospectus is also revised continuously. Next is marketing and updates. Marketing materials are created for pre-marketing of the new stock issuance. Underwriters and executives market the share issuance to estimate demand and establish a final offering price. Underwriters can make revisions to their financial analysis throughout the marketing process. This can include changing the IPO price or issuance date as they see fit. Companies take the necessary steps to meet specific public share offering requirements. Companies must adhere to both exchange listing requirements and SEC requirements for public companies. Next, we will talk about board and processes. Form a board of directors and ensure processes for reporting auditable financial and accounting information every quarter. Next is shares issued. The company issues its shares on an IPO date. Capital from the primary issuance to shareholders is received as cash and recorded as stockholders' equity on the balance sheet. Subsequently, the balance sheet share value becomes dependent on the company's stockholders' equity per share valuation comprehensively. The last step is post-IPO. Some post-IPO provisions may be instituted. Underwriters may have a specified time frame to buy an additional amount of shares after the initial public offering date. Meanwhile, certain investors may be subject to quiet periods. That's it for today, and I hope you found the video useful. You can contact us from the details mentioned on the screen via call, email, or WhatsApp. Thank you for watching the video to the end. Please do like, share and subscribe our video for the latest updates in the stock market.